equity access, your cross-section of the stock markets and of developers in the Zimbabwean economy. Ibn Mabunda signing in. Let's get on to business. Our news tonight, One Money is now offering a collateral-free loan service known as Katsaona. Well, Katsaona is a Shona word which means an emergency or times of trouble. So yes, Netone is saying we're offering you a relief in times of trouble. Now, One Money is a mobile platform that is of course run by Netone that has a subscriber number of 241,566 subscribers across the country, which represents 3.8% of the country's mobile subscribers. Well, of course, this service would be akin to EcoCash's nano loan service, which is also known as Kashagi, which was launched just a few weeks back. Well, in the same way, EcoCash partnered with Stuart Bank to launch this Kashagi. They have also partnered with One Money. They've also partnered with the Women's Bank, this very service, which is now known as Katsaona loan service. Details are that you can borrow at least $10 to a maximum of $50. Payback period is 30 days at a 10% interest rate. Well, in case you fail to pay back on time, you will then be required to pay at a rate of 15%. Well, this means that there is now competition in the fintech space to Untu's Ugain as well as Getbacks, not forgetting of course the Cassava flagship EcoCash, which is running through the service Kashagi. Notably is the fact that this is a model that has just been borrowed from Kenya. Well, in Kenya they are running what they call one which is facilitated through M-Pesa, and according to the stats, M-Pesa through its facility was able to get 5% of its subscribers to actually enlist on the facility within the first week. So if we go according to stats, then that would mean that this service would attract about 12,000 subscribers in the first week. But question is, will Katsaona be able to match the standard set by M-Pesa? Moving on to our next story, Telone, which is one of the country's biggest players in the internet service and the sole operator of fixed telecoms, has announced the revision of its prices in consideration of the monetary policy statement, which then through the Interbank system has introduced the RTGS dollar as well as exchange rate. Well, of note, according to the statement, is the fact that they have said that Telone notes the announcement of a rate of exchange between the US dollar and the RTGS dollar. We further note and point out that our tariffs and charges are currently denominated in the US dollar. With this observation, Telone would like to advise that our tariffs and charges will remain unchanged. Take note, unchanged in US dollar terms. We will, however, now have tariffs and charges indicated in RTGS dollars as well. So what these guys have simply done is they've said, look, in US dollar terms, we've really not changed anything. However, we have changed stuff in terms of the RTGS. In essence, if you just have a quick look at the prices, you realize that they've maintained the exchange rate of $1 US as to 2.5 RTGS dollars. But question, how economically viable is that model given the fact that currently the RTGS is trading at a rate of 2.9 against the dollar? So we might perhaps want to see how that actually fares and whether or not they will be forced to revise their charges upward given the prevailing exchange rate between the RTGS and the US dollar. On to our next business story. ZSE listed Edgars store Zimbabwe has successfully acquired Edcon brands. We've reported on this story a couple of times, but just to jog your memory, on the 16th of January 2019, a deal was struck between Edgars store Zimbabwe and the parent company Edcon, which is listed on the Johannesburg Stock Exchange, with a 38% stake in Edgars Zimbabwe. Well, the deal involved the $1.5 million deal in exchange of 15 million shares in Edgars, right? In exchange for the ownership of Edgars brands, Jet, and of course the flagship Edgars. Well, this on the part of Edgars is meant to enhance their profitability by reducing the franchise fees that they had to pay annually. So that, of course, would be a positive for the corporation Edgars, while, of course, for Edcon, there is increased stake from 38% to 41% shareholding. Just also to jog your memory, remember that recently Edcon has been involved in debt issues, and in a positive development, they managed to secure increased capitalization of $191 million for them to stay in business. So this, of course, would be an interesting development, and would like to see how the story actually fares. Last detail on the story: much as the deal was sealed on the 16th of Jan, well, it was subject to regulatory affairs as well as exchange control with the Zimbabwean government, which have now been put to bed. So there we have it, thumbs and a win there for Edgars as they move forward with that. In another story, the Central Securities Depository, the CSD, run by Chengetedzai, has issued a monthly update for the month of February. Now, what is this? Created in 2013 to dematerialize shares into a virtual format. What this basically means is when you buy shares, you take your share certificates and you then take them to the CSD, and then they are converted into their virtual format. Well, the system facilitates then the buying and selling of shares by way of linking buyers and sellers together with the broker to facilitate the trade. Positives that come with the system are that there's reduction of paperwork, enhanced security, as well as reduction of settlement time in trade. Well, on to the report details. At least 171 CSD accounts were opened during the month of February 2019, representing a 49% drop from the previous month. The market capitalization of securities which are placed on the CSD went down by 2.98%. Which is from $9.2 billion in January right to $8.9 billion as of 28 February 2019. Now, if we're to get into the percentage of distribution of market cap by accounts class, you'd realize that you have foreigners occupying 27.7%, which is roughly 28%, corporates 23%, insurance houses 22%, pension funds 18.4%, deceased estates 5.8%, individuals 2.3%, and unit trust funds 0.3%. Well, we will have a conversation on this subject, and I'll be joined by one of our very own analysts. So please stay tuned as we take a break. Welcome back, viewers. I'm now joined in studio by our very own chief analyst, Respect Gwens. Respect, good evening and welcome to the show.
Thank you. It's my pleasure. Good evening, viewers.
Beautiful. Let's get the ball rolling. Interesting development there by One Money introducing a collateral-free loan service known as Katsaona, which means an emergency in Shona.
Sure.
What is your understanding of the situation? What is the implication of this?
It's a positive move by the telecoms player. I think over the past few months, in fact for a year now, they've aggressed in terms of pushing their mobile money subscribers they're enjoying the fastest growth rates in that space. Although they're coming from a very low base, I'm sure they closed the year at around 270 thereabout, and that was a growth of about 32% quarter on quarter. But on aggregate, that's about 3.8% of the total industry. I mean, mobile money subscribers in the market. So I think it's a very positive move. It's a very positive move. They're leveraging on a key asset that's growing within the portfolio of the telecoms company. So I think it's a very positive move, leveraging on that, but they're still on a very low base. Looking at just 200,000 subscribers compared to Econet, which is moving close to 6.9 thereabout. I think Econet has got that cloud, and it has got a larger base on which it can expand, or it can move its own product. So I think it's wise, it's wise, and it also gives more value to the customer, which I think is beneficial for the company's growth in terms of revenues and profits going forward. But this has been a loss-making entity for quite some years now. 2018 could be no different. Actually, for Netone, they've invested heavily in terms of their marketing and coming back to the market with different products in 2018. And One Money has been the product that has been taking out some of the investment outlay in that respective year. So obviously, it's gonna have a dent in terms of their costs, in terms of their overheads and some other operating costs in that year. But it's a good prospect, I think, for the company. They're following the market, and they are leveraging the growth in One Money. And I'm sure the present CEO is very passionate about that very unit, the mobile money side, and that's where they could compete, and that's where things are looking to head towards. And obviously, doing the deal the way they did with the Women's Bank is quite a positive. But on another note as well, before you interject me, I think there's the issue to do with viability in the environment at an interest rate of 10%, and also given the background of surging inflation. I think it also defies logic to come into the market with an interest rate of 10%, whereas inflation is rising at a much faster rate. I think going forward, there's a need for reviewing such interest costs. But it's the way that they've introduced the product to market. It's a ready product, and they will benefit from it, or from its growth as we go.
You rightly mentioned the prevalent inflation and all that. I'm sure it's been a bit of a turbulent ride for the average customer. So I think this comes at a right moment where subscribers will be quick to actually see to it that they enlist themselves for the service that is actually at hand.
Yeah, but you'll be subsidizing the customer, and who loses at the end of the day, because your own inflation is at 50 or 59%, and you're giving out your monies at 10%. It simply means you're loaning out at a loss. So in essence, it's not really to the customer. Yes.
From the customer perspective.
Yeah, but you can't continue to sink money just for the benefit of the customer when you're losing real value. It has to come at a favorable interest rate. The aspect of micro financiers is to avail cash flows to those in need, but at rates which are not suboptimal. They have to be within range of competitiveness, because you need to repay. The Women's Bank actually secures monies out, from somewhere, and they need to compensate that money. It has to come at a fairer interest rate, which is actually competitive, like you've mentioned. So, but I think it's a short-term thing. Once this whole inflation issues and market volatility is cleared, then we might start to see real benefits of such a move.
But what would be the significance of this where the sector is concerned? I'm saying there are other players. We've got Getbacks, and we rightly mentioned the cassava one, which is Kashagi, and you also have sort of in the same bracket, you also have Ugain there by Untu. How could this potentially change the outlook of the sector?
It's a real game changer for the broader MNOs to start focusing on offering credit to their customers. It's actually convenient because you are a Mbari Msika shop operator. You're operating your store there at Mbari Msika. You want to make an order for your vegetables. You obviously need between $50 to $100 to start doing something, and so it's actually a way of capitalizing these small players in the market. And obviously over time you are able to also grow and maybe borrow at an increased scale, or even to start utilizing normal banks. But the key feature there is the interest rate component. On average, most microfinanciers, the average interest rates are hovering at around 18%, and 10% is a very competitive rate, which you only find with banks. I mean, such an interest rate, you can only find it with banking operations. And I'm sure if you look at Econet's own structure as well, where they offer airtime credit, they also use that kind of interest rate as well. So for the Stewart Bank and EcoCash's product, which is Kashagi, they also have got such a similar competitive interest rate. So from a competitiveness point of view, their product is very competitive, and I'm sure it will find takers depending on the scale of their customer base.
Okay. Moving on to our next story, Telone here issues an interesting statement. They says, look, they say, look, we have not increased our fares. They're still static in terms of US dollars. However, they've also increased their prices in RTGS at a rate of 1:2.5. What would be the relevance of such a move?
It's very huge. It's very significant. Telone is 100% owned by the government, and over the years it has been making losses. And right now there is a movement towards trying to sell part of the shareholding in the company to an outside player. And so there is really they're really at a point where they can no longer keep on accumulating losses. In fact, they've got a serious legacy debt that's hanging on their head, and so they need to start doing things in a proper market manner. And so adjusting rates at this point is very prudent and it's very timeless. You need to move with the market. The biggest player in that market, because when I was looking at the kind of market share they enjoy about 38% market share in the data space, next to Zoll, which is dominant at 50 something thereabout, and their service has been growing. In fact, Telone's own data service is now bringing in more money than normal voice calls. And so it's really important for them to move with the market. And what do I mean by that? If you look at the biggest player in the market, which is Zoll, it has been shifting. It actually shifted. It's using almost a similar regime of pricing since about 3 weeks ago, when they said we are altering our prices. But their model is quite flexible. It's open to the exchange rate. So if today's Interbank exchange rate is at 2.9, you go there and they'll calculate $70 multiplied by 2.9. If tomorrow is at 3 or at 5, they will still have to calculate that. So that becomes your cost. But with Telone's rates, they are more like capped with an exchange rate, at an exchange rate of 2.5 times. So that's less flexible, and it impacts them negatively in case where you find in case where the exchange rate keeps on tumbling. So I think basically this is a positive move by Telone. They're moving with the market. They're trying to also hedge themselves. They need to invest. They need to bring in more equipment. They need to bring in a lot of stuff to keep on the growth momentum on the data side, and they need that money in Forex, and so they have to price their product correctly. So I don't think it's going to impact their demand at all, because the biggest player who's got the largest market share has already made a move, and that move is to increase prices or to do a pro rata with the USD. So it's really in line, and it hedges them against sustained loss positions going forward.
I agree with you, that is a positive, but I'm a bit concerned about the rate. 2.5, I think they would need to revise that as they actually make progress.
Yeah, but also there's the government aspect. In as much as they are moving towards becoming a private entity, still government has control. And so obviously in asking for approvals and engagements, there's always that push to say you should meet the people halfway. You shouldn't push as far. But a clear rating to market is an indication of their intention to start to do things in a more business-like manner, and that's gonna work out for them in future. I'm quite definite about that.
Okay, on to Edgars. Well, they've successfully acquired the Edcon brand. I know we've discussed this before, but just to talk about the relevance now that it has actually sailed through, because it was subject to a couple of regulatory bodies, and now that this has actually sailed through, what does this mean for Edgars?
For Edgars, it means further cost savings. Edgars was failing to pay Edcon, which is the largest shareholder within the entity, its dues with relation to rights to use the two major brands, which is the Edgars brand as well as the Jet brand. Jet is a recent brand. In Zimbabwe, it's just about 5 or so years old, in fact, maybe even less. And so those two brands, they are supposed to, the rights to use those brands is supposed to be paid for on an annual basis, and that's in forex terms because these are foreign brands. So given the background of forex challenges in Zimbabwe, Edgars Zimbabwe has been failing to settle those. So I think the debt had accumulated to about, the outstanding payment has accumulated about 3-point-something million US dollars. And so there was a decision to say, let's rather convert this debt into equity and also further price in the two brands in terms of, shifting of ownership. So they paid for the shift in ownership through extending the shareholding as well as obviously covering the outstanding amount. So all that was factored in through an increase in the actual shareholding by Edcon. So it's a positive. It results in cost savings, but I think it also came at a very opportune time. This was a time when Edcon was in a crisis, and there were also fears that there could be changes in management, maybe even changes in the shareholding structure. Lately, they got secured money from IDC and all sorts of investors. So there's always that uncertainty with regards to sustainability of using those brands going forward. Okay. So when Edcon acquired an additional share and ceded these brands to Edgars, it was a very clear move to say, even if there might be a change in ownership, you can no longer reclaim these brands. These brands are now due to you. So suppose the major shareholder would have sold their Zimbabwean operation, the new shareholder had no right at that point to acquire back to reacquire the brands from Edgars. So I think it also brought in a bit of calmness and clarity to regards to sustainability of using those brands. So it's gonna be some cost savings. There's gonna be clarity in terms of the sustainability, and those are some of the key takeaways from this initiative.
This development. Fair enough. Then a report there from the Central Securities Depository and the CSD. Well, according to the report that they've just published, market capitalization of securities went down 2.98% to $9.2 billion. From $9.2 billion to actually $8.9 billion. What do these figures tell us as well? Also factoring the fact that you have foreigners who are at a position of about 28% by distribution of market cap. What is the significance of these figures? What are they indicative of in as far as the stock market is concerned?
If you are to look at distribution of market cap by accounts class, that's a very, very insignificant ratio. In fact, it has no purpose. Why am I saying so? Market cap is a function of price and volume sold. So it's a function of, it's actually, market cap is a function, sorry, it's a function of price and shares in issue. That's how you calculate market cap. So when they give this figure, they're trying to say if company A has had a dematerialization ratio of 70%, then we are now recording that company A as a company that's already dematted, right?
Right.
So A is dematted. What is its market cap on the market? Its market cap in terms of, you just taking to say, maybe it's cassava. So you're just saying cassava's market cap is this much. So they're simply saying of the companies that have been dematted, what are their market caps on the stock market? So whenever you're going to market cap as a reference point, you are now subjecting your analysis or review to the share price movements. So the decline to say February from January that you have seen is just a function of price movements on the stock market.
Right.
So this is, if there was a decline, like you mentioned, you said there was a decline in terms of...
There was a decline of about 3%.
So this is just a decline in terms of share price movements in the companies that are dematted. So they are calculating a market cap of the stock market based on only the companies that whose shares have been dematted. Okay. So the fact that it has moved down does not mean much in terms of it has got no significance in the dematerialization process, but it has a significance in terms of the actual trends. But now to get back to the levels or the levels or the ratios, this chart really shows us that foreigners have been at the forefront of dematting the shares. Why so? The largest component of foreigners involved on the local market are mainly institutional investors. So this is your Sanlam, your Alan Gray, all these international asset managers based in United Kingdom and in South Africa. And so these are the most active participants of the stock market. They're playing from one counter to the other. And so obviously they are motivated to demat their shares.
Okay.
Going into the aspect of corporates also place their investments strategically. So today they want to place their monies in stock markets. They want to place in money markets depending on what the economic situation is like. So they are also at the edge. They move their shares frequently. So also they might be pushed to demat their shares, the same as insurance and pension funds. This is why you find high ratios in mainly these institutional side.
Yeah.
And when you're getting back down to individuals and deceased estates, the ratios are quite minimal. But in terms of depth, I think we're still a long way to go before we see a complete dematerialization of all the shares that are on the stock exchange. Individuals, they mainly keep their shares in hard certificates and only sell them as and when they want to sell. They can only change them as and when they want to sell. So that's also one factor why you would find a lower ratio on individuals.
What would be perhaps the potential of us actually going towards such a trend of dematerializing? I mean, it's become something that is quite common, in other parts of the world. What potential is there for Zimbabwe where that is concerned?
When you say potential, are you trying to say we are not yet there, or what? Or you're saying can we increase the rate?
Yes, especially where the individuals are concerned.
Okay, so I hold shares. Why would I be pushed today to go and demat the shares? I can only demat the shares motivated by the need to sell, because I cannot sell them before they're dematted.
Right.
So individuals, so all these players, they've got a motive, and their motive is they're frequent traders. So once they trade, if they want to dispose of their shares, it means they should demat their shares first. So insurance companies and whatnot, they really have got people who are ready to actually take the shares, demat them, tell them that we have dematted 27% of your investment in A to this. But individuals, you need a motivation, and that motivation is the need to dispose. So once I feel the need to dispose of some of the shares that I have, then I'll have to go to the demat side.
I realize.
So if you go to the demat, they will dematerialize your
Welcome back, viewers. Sincere apologies for the interruption there in transmission. Just a glitch in that regard. Now back to where we were with respect to explaining how we could potentially see perhaps changes with regards to individuals, and you explaining the meetings.
So there might be need for further campaigns to actually spell out the advantages to various players, to say, if you demat your shares, this is what's going to be your advantage. I'm sure you detailed some of the advantages, right, to say your shares are a bit secure, and also you are able to transact fast, and also it helps put together the whole ecosystem and reduce excesses in terms of the general flow of shares, and it actually reduces the time over which settlements against share sales can be done. It feeds into the broader ZSE system, the newest system, which actually makes trades settle at a very faster pace. So I think it's something that the CSD needs to do, relook into the matter and see how best they can engage clients in terms of moving shares onto the CSD platform. But I think at this rate we are okay. We are moving in the right direction, and we are now trading on a T+3, which is 3 days of settlement, and that's the best that you can find in the world. But shares needs to be secure. People need to take their shares, demat them, such that in the event that they want to sell, they can do it at a very swift pace. You don't need to go back again with your shares. And so once your shares are dematerialized, the next thing is to give your broker a call, tell him to trade the shares, and you're done. 3 days, your money is in the account.
Well, thank you, Respect, for the insights. Thank you, viewers, for watching. Up next is Money Markets. Please stay tuned.
Welcome back, viewers. I'm Anisu Chumbumu, and welcome to Money Markets with Respect and I.
Yes.
Good evening, Respect. How are you doing today?
I'm doing great. Let's kick the ball.
All right, that's cool. So today it seemed as if the market was pretty on the positive side today.
Sure.
Opened the week on the positive, coming up 0.2% for both the all-share index and the industrials index.
I think we experienced quite some green movements on the stock market. A lot of heavy caps recovering. In fact, 4 of the top 10 counters were on the recovery path. But I think for context, maybe we need to get back again into a bit of reference over what has been transpiring over the past few weeks. So I think we are now at week 4 of successive losing sessions, and just the past week had some quite huge margins in terms of losses, 8-point-something% for the top 10, and about an average of about 5% losses in 2 of the other indices, minus the mining index. But I think the background as well is that there's been a lot of shifts in the market over the past few weeks, especially after the MPS, and investors have been trying to move shares. Others are trying to find liquidity, and there's a lot of capital threshold revision across different sectors. Most of the companies are now demanded to keep higher thresholds, or much of their monies in prescribed assets, so they definitely have to move monies from shares and whatnot. And there's others as well who have been expectant of getting cash flows on the interbank market. I think this is only the foreign investor kind of so those are exposed in a way, because liquidity has been low. I think the RBZ has been suppressing the rate at 2.5, but we're beginning to see marginal movements, and I think we are now about 16% up since the beginning. So today's revision is quite marginal given the depth of prior week losses, but significantly our year-to-date losses are not looking good. Even the month-to-date, that's from when we began the month.
You did mention that some foreign investors were finding the interbank market being somewhat attractive in terms of them trying to find a way outside of the market. We did realize that Old Mutual, which is one of the fungible counters, had somewhat of a good week. In the prior week, it had about 2 or 3 sessions, if I'm not mistaken, where it was on the green side. But then today it did open on the negative side, which pretty much had it come off by 1.75%. Do you think there's a little bit of context around that?
Yeah, I think the movements around Old Mutual have not been, because it's trading at a very huge premium on the I mean, compared to, I mean, the implied rate compared to the interbank rate, as well as the parallel market rate. So I think there's been correction in intervals here and there, but it has predominantly been on the upside. But I think if we are to look generally at how the market has performed, I think it's taking a cue from what's happening on the interbank exchange. Why so? Because there's been some drastic value loss. Trading at 2.9, it means your RTGS value is fast losing. It's value. It's value. So if volumes are not enough on the interbank market, it means you are further pushed to come back into stocks. So I think for mainly foreigners, it's an evaluation that they have to continually make to say, are these rates still sustainable to keep pushing my money on the interbank rate and wait for when I could get an allocation. So beyond certain levels, they might be pushed back into stocks. And also for even those who are holding their money as hard cash as well, you get to levels where you start to see the interbank running and you're like, so am I going to lose further value? So in terms of Old Mutual, I still feel it's overly priced against against relative to other local exchanges. Let's move forward.
Well, all share index on a 5-day trend is down 6.11%.
Sure.
And the top 10 index is still showing to be the heaviest counter in terms of the drag on how the stock market has been performing, especially if you look at the year-to-date performance currently. It's down 8%, and then the industrials index is down about 6.19%. The minings index is still very much stable.
Yeah, there hasn't been as much movement in terms of the mining sector,
Yes.
but I think as results come in, we might see a bit of changes to the stable rate. But I think generally the movements on a week-to-date basis are feeding into the prior, because they're taking 4 days from the prior week, and that's Tuesday up to Friday.
Yes.
And that's the period around which you experience some really hefty losses. So
Yeah.
today's gain could obviously only marginally shave
a little bit of the losses from there. All right, for our risers and fallers, today it seems as if the bulls were overcoming on the bears today, with about 7 risers and just about 4 laggards on the market. Leading the bulls were the FMO stock coming up 16.46% to settle at 12 cents, while the banking stock CBZ added about 6.67% for it to 16 cents.
Sure.
Insco 2.29%. On the other hand, Axia and Padenga seem to have been having a good run. Today it's come off on a huge number.
It has really enjoyed a very good run. I think it's the only top 10 counter
in the green,
to be trading in the green, up 12.35 on a year-to-date basis. But today
it did come off about 2.55%.
Yeah, so these two counters specifically, they are quite unique in terms of
its fungible.
Yeah, Old Mutual is fungible,
and then Padenga has got foreign currency earning power.
It is a serious foreign exposure, and so to find them coming off on such a day is actually quite a surprise.
Well, it was pretty much of a damp day on the stock market. Volumes actually were down about 98% from the prior session.
Wow.
Around about 200,000 shares that were traded on the stock market. So it could be pretty much that effect there. And then Truworths actually kept the laggard cert, coming off 0.62% for it to settle at 1.6 cents.
So with Truworths, I'm sure it released its financials a few, in fact, last week.
Yes.
To be specific, and the performance there, it wasn't as very much pleasing. They're now decrying that volumes, in fact, demand from the final quarter onwards has been low.
Well, definitely, because I mean, inflation if my pocket is hit by inflation, I'll start taking off some of my luxury.
Yes, and
luxury
clothes. I'm sure they fall within that category.
Yeah,
I'm sure there are a lot of.
It's a necessity when you look at Maslow's hierarchy. But
it's a necessity, but you can scale down the quality.
Yes, the quality
sure
and the frequency. Yes. So the frequency then comes off. I mean, yes, they did enjoy an increment in their credit accounts. But then that doesn't really translate into their revenues on a very immediate effect. So going forward, they are expecting a much damper volume performance there. So it could really much affect their revenues. Not knowing how much more inflation is going to push people outside that market there going forward into the year. But it will be a tough time for such counters. I mean, Edgars has actually had a change in its ownership structure. 42% is now owned by the Edcon company, up from 38%.
Sure.
I wonder how that's going to work out for them, because I mean, it could have them gaining a little bit more foreign currency favor thereabout for them to actually attain some of their clothing materials, so that they could.
I think the relationship is already it had been like there, and Edcon has been responsible for pushing some of the credit to the Zim unit, and so I don't think it's gonna change much in terms of pushing Edcon's interest. But I think we will wait to see if there are gonna be any fundamental changes. But for now, cost savings through acquisition of branding rights. I think that's the most, significant
thing,
pick from there. Let's move on to forex trading.
Okay. The old mutual implied rate did come off slightly again. It was trading about 3.73 today, while the parallel market seems to be very much stable since last week. It's still trading around about 3.8. I'll suggest probably the old mutual implied rate came off also because the ZSE stock was actually down as well.
Okay.
So that could have been the huge effect around there. But the interbank rate, interesting, is still going up.
Wow.
It's at 2.96. That's almost at 3. I wonder if that marginal space is still gonna remain, because I mean pretty much most of last week the interbank rate has been moving towards the parallel market rate, but it seems as if the parallel market rate is still a little bit stable.
It's still pushing up a bit. Was it at 3.80?
Yeah, it's been pretty much at 3.80 for the last 3 sessions.
Okay.
Yeah.
So it's quite an interesting phenomenon there in terms of the FX market. But I think as we move forward, it's important for us to check closely how tobacco flows filter through, and also the debts, the moratorium debts.
Yes, that's a huge factor.
We are in that period as well, so that might also impact liquidity as we move forward. But it remains to be seen whether there's that huge liquidity in the market or not. But if you are to look at what the governor said, he expects the rate to fall as we start the season.
Yeah, but I wonder how many companies have not yet been able to actually use their foreign currency within the.
Yeah, I think it's a matter of structuring, because it's not about just basic use. Because as a company, you need to create savings. You need to. So I think
which is pretty much deterrent with this 30-day moratorium, would it not?
Yeah, it's really deterrent. You can't push a company to utilize resources that it doesn't want to utilize, or convert them into a currency that they don't want to. Yeah, but then there has to be a way of balancing it out. I think it's not outrightly fair to push. So sometimes you might be pushed to acquire foreign assets simply because you've got the liquidity. You start acquiring things that you don't need. So I think there has to be a way of reconciling those two different positions.
Yeah,
but generally, I believe there is potential for the rate to come off, but it's only dependent on government's ability to constrain money supply. If money supply is to come down, if they turn back their borrowings and whatnot, then we might not see further growth in the exchange rate. People need to gain confidence. People hold money, your Zimplats and whatnot. They need to know that their money, even if they sell it today, they can buy tomorrow at a good exchange. They will find the money in the time that they need it, and even at a better rate than which they sold. So you need to instill that confidence. So before people can actually have confidence in the system, it's very hard to even push those who have the money to trade it, unless you push them to do so, or you use force to do so. So it remains to be seen.
Oh, all right. Well, that's it from me in respect on the stock markets and the money markets. Please do not forget to like, follow, and subscribe on our Facebook, Twitter, and YouTube channels at Equity Access on all 3 platforms. And also do take a visit on our website www.equityaccess.net. Now, that's from me in respect. Good night.